Most people think gold is one of the safest investments you can make, and in many ways they're right. Gold has survived wars, economic collapses, currency crises for thousands of years. Central banks are buying it, institutions are holding it, investors trust it. But here's the part almost nobody talks about. Not all gold investments are good investments. In fact, some of the most popular gold investments right now are also some of the worst. And what makes this even more dangerous is even experienced investors get this wrong. Because they focus on the wrong thing. They focus on gold itself instead of how they're investing in it. And that difference changes everything. Because gold is not just one asset, it's an entire ecosystem: physical gold, paper gold, mining stocks, ETFs, coins, bars, derivatives, and each one behaves completely differently. Some protect your wealth, some amplify returns, and some quietly destroy your returns without you even realizing it. So today, we're breaking down the top 6 worst gold investments right now, not because gold is bad, but because choosing the wrong exposure to gold is one of the biggest mistakes investors are making in 2026. Because here's what the data actually shows. Gold has been one of the strongest performing assets in recent years, driven by geopolitical tension, inflation concerns, and market uncertainty. But at the same time, that performance has created something dangerous: overconfidence, speculation, and in some cases overpricing. And when that happens, certain types of gold investments become inefficient, even risky. Let me show you what I mean. Because the first worst gold investment is one that looks incredibly safe. It's simple, it's accessible, and millions of people own it. But it has a hidden problem most investors ignore: gold ETFs. Now, before you jump to conclusions, let's be clear. Gold ETFs are not bad in every situation. They're liquid, easy to trade, and widely used. But here's the issue. You don't actually own gold. You own a financial instrument that tracks gold. And that distinction matters more than most people realize. Because when you buy physical gold, you remove counterparty risk, no middleman, no dependency, no financial system exposure. But with ETFs, you reintroduce that risk. You're relying on a fund managers, custodians, market structure, and liquidity conditions. Now, in normal times, that works fine. But during periods of stress, that's where things can break. And here's something even more important. Gold ETFs don't produce income. They don't generate cash flow. And historically, gold itself doesn't either. Which means your entire return depends on price movement. And if gold enters a sideways phase or underperforms for a period, you're holding an asset with no yield and no compounding. And this is where many investors get trapped, because they treat gold ETFs like stocks. But they're not stocks. They don't grow earnings. They don't reinvest profits. They don't scale. They just sit there tracking price. Now combine that with something happening right now in markets: interest rates. When rates are high, gold becomes less attractive because it has no yield. And suddenly investors start comparing it to assets that do produce income: bonds, treasuries, dividend stocks, and that creates pressure. This is why gold doesn't always perform the way people expect. In fact, its relationship with inflation is more complex than most think. Sometimes it protects against inflation, sometimes it doesn't. And when expectations don't match reality, investors get disappointed. So the problem with gold ETFs isn't obvious, it's structural. You think you own gold, but you don't fully control the asset. You think it's a long-term investment, but it doesn't behave like one. And most importantly, you think it's simple, but the underlying mechanics are not. Now here's where it gets even more interesting, because the second worst gold investment is the complete opposite of ETFs. Instead of being too financial, it's too physical. We're talking about high premium physical gold products, coins, collectibles, limited editions, numismatics. And on the surface, these look amazing, beautiful designs. Historical value, limited supply. But here's the reality. You're not just buying gold. You're paying for marketing story, scarcity perception, and dealer margins. And those premiums can be massive. Sometimes 20%, 30%, even higher. Now here's the key problem. Gold itself might go up, but your investment still underperforms. Why? Because you have to overcome the premium first. You're starting behind. And when you sell, you don't always recover that premium. Dealers don't pay based on what you paid. They pay based on spot price demand and resale margin, which means once again, you lose before the market even moves. And this is not just theory. Even basic comparisons show this clearly. Lower premium gold products like bars typically carry smaller markups, while coins and collectibles often cost significantly more for the same gold content. That difference? That's your lost efficiency. Now here's the deeper insight. This isn't just about gold. It's about how markets work, because every asset has layers. And the more layers you add, the more inefficiency you introduce. Simple assets tend to perform better. Complex, packaged marketed assets often benefit the seller more than the buyer. And gold is no exception. Now, if you think those are the biggest mistakes, they're not. Because the next one is where even experienced investors get caught. And this is where things start to get serious. because this next gold investment looks like leverage, looks like opportunity, looks like a way to amplify gains. But it can just as easily amplify losses and wipe out your position entirely, and this is where the real risk begins. And this is where things start to get a lot more dangerous, because now we're moving into a category of gold investments that don't just underperform, they can actively destroy capital fast, and sometimes permanently. We're talking about gold mining stocks. Now, on the surface, this idea makes perfect sense. If gold goes up, gold mining companies should make more money, which means their stocks should go up even more. Right? That's the logic most investors follow, and sometimes it works. But here's the part most people don't understand. Gold mining stocks are not gold, they are businesses, and businesses come with problems, costs, debt, management decisions, operational risks, political risks, and market risks, all layered on top of gold prices. So instead of tracking gold directly, mining stocks behave very differently. In fact, there have been long periods where gold prices went up, but mining stocks didn't follow. Or worse, they went down, because their costs increased, or production dropped, or margins got squeezed, and this is happening right now in parts of the industry, because mining costs have been rising, energy, labor, regulation, all getting more expensive, which means even if gold prices are strong, profitability doesn't always improve the way investors expect. Now here's something even more important. Mining stocks are highly volatile, much more volatile than gold itself, because they act like leverage plays on gold. When gold rises, they can rise faster, but when gold falls, they fall harder. And when the market gets uncertain, they often get hit from both sides. Gold might stagnate while equities sell off, and mining stocks sit right in the middle, taking pressure from both directions. This is why many institutional investors treat mining stocks very differently from gold. They don't see them as a safe haven, they see them as a risk asset. And that distinction matters, because during market stress, risk assets behave very differently. Now let's take this one step further, because if you think mining stocks are risky, the next category takes that risk and multiplies it. We're talking about leveraged gold ETFs. Now these products are designed to do one thing, amplify daily moves, 2x, 3x, sometimes even more. So if gold goes up 1%, these ETFs might go up 2% or 3%. Sounds great, right? But here's the catch, they reset daily, and that changes everything, because over time, their performance can diverge significantly from gold itself, especially in volatile markets. Let me explain this simply. If gold goes up and down repeatedly, even if it ends at the same price, a leveraged ETF can lose value. Why? Because of something called compounding decay. Each daily reset eats into the value over time. So instead of amplifying returns, these products can slowly erode your investment. And most investors don't realize this. They hold them long term, thinking they're just boosted gold exposure. But they're not designed for long-term holding. They're designed for short-term trading, and using them incorrectly can be extremely costly. Now combine that with volatility, and the effects get even worse. Because the more volatile the market, the faster the decay happens, which means the exact environment where you expect big gains can actually produce losses. This is one of the biggest traps in the gold market, because it looks simple, but the mechanics underneath are complex and unforgiving. Now let's go even deeper, because there's another category that takes complexity to a whole new level. And this is where even experienced investors make serious mistakes, gold futures and derivatives. Now these are powerful tools used by institutions, hedge funds, professional traders, but they come with a level of risk that most retail investors underestimate. Because when you trade futures, you're not just buying gold. You're using leverage, sometimes significant leverage, which means small price moves have large impacts on your position. If gold moves against you even slightly, you can face margin calls, forced liquidation, or total loss of capital. And this can happen quickly, faster than most people expect, because leverage doesn't give you more control, it gives you more exposure. And exposure without proper risk management is dangerous. Now here's something even more important. Futures markets are driven by more than just gold prices. They're influenced by interest rates, currency movements, liquidity conditions, and institutional positioning, which means even if you're right about gold long term, you can still lose money short term. And that's what makes this so difficult. Because timing becomes critical, and timing is one of the hardest things in investing. Now let's step back for a second, because if you're noticing a pattern here, you're absolutely right. The worst gold investments are not random. They all share certain characteristics. They're either too complex, too expensive, too leveraged, or misunderstood, and in most cases, they combine multiple of these risks at once, which is why they catch so many investors off guard, because they don't look bad on the surface. They look like opportunities. They look like smarter plays. They look like ways to outperform. But underneath, they carry hidden risks. And those risks only show up when it matters most, during volatility, during stress, during uncertainty. And that's exactly when investors are most vulnerable. Now here's where things start to shift, because understanding what to avoid is only half the equation. The real advantage comes from understanding why these mistakes happen in the first place. Because once you see that, you stop repeating them. And that's what we're about to get into next, because the final 2 gold investments on this list are not just about structure, they're about psychology, behavior, and how investors think during uncertain times. And this is where everything comes together. Because once you understand this part, you don't just avoid bad gold investments. You start thinking like a completely different kind of investor, and that's where the real edge is. And this is where everything comes together, because the final 2 gold investments on this list are not just about structure, they're about behavior, psychology, and how investors react when markets get uncertain, and that's exactly why even experienced investors get this wrong. Let's start with the 5th one, gold IRAs with high hidden fees. Now at first glance, this sounds like a smart move. You're holding gold inside a retirement account, tax advantages, long-term protection, diversification. It checks all the boxes. And that's exactly why it's so appealing. But here's what most people don't see, the fee structure. Because unlike simply buying gold directly, gold IRAs come with layers of costs, custodian fees, storage fees, transaction fees, annual maintenance fees, and sometimes markup on the gold itself. Individually, each one might seem small, but over time they add up and they compound, year after year, quietly reducing your returns. Now here's the part that makes this even more important. Gold itself doesn't generate income. No dividends, no yield, no cash flow. So those fees, they're not being offset by anything, they're just coming out of your investment every year, which means even if gold performs well, your net return can still be lower than expected. And if gold moves sideways for a period, those fees can eat into your capital significantly. This is why many investors underestimate the long-term impact, because the cost isn't immediate, it's gradual, hidden, and compounding. And that's what makes it dangerous. Now, this doesn't mean all gold IRAs are bad, but high fee structures, those can turn a solid idea into a weak investment. And once again, it comes back to the same principle, efficiency. Because in investing, small inefficiencies over time create large differences in outcome. Now let's move to the final one, and this might be the most surprising of all, because it doesn't look like a mistake. In fact, it looks like the safest option possible, holding too much gold. Now this one doesn't get talked about enough because gold has a strong reputation, safe haven, store of value, protection against uncertainty, all true. But here's the problem. Gold is not a growth asset. It preserves wealth, but it doesn't build wealth the same way productive assets do. It doesn't generate income, it doesn't expand, it doesn't innovate, it doesn't compound in the same way businesses do. So when investors allocate too much into gold, they create a different kind of risk, opportunity cost. Because while gold is holding value, other assets are growing, stocks, businesses, innovation sectors, technology. And over long periods, that growth compounds, which means portfolios that are too heavily weighted in gold can underperform significantly, even if gold itself performs well. Now here's where this becomes a real issue. During uncertain times, investors tend to move towards safety. They increase their allocation to gold, they reduce risk, they protect capital, and that's understandable. But sometimes that shift goes too far, and instead of balancing the portfolio, it limits it. Because investing is not just about avoiding losses, it's about capturing growth. And gold alone cannot do both. This is why institutional investors think differently. They don't go in on gold. They use it as part of a broader strategy, a hedge, a stabilizer, not the entire portfolio. And that distinction is critical because it changes how you think. Gold is not the solution to everything. It's a tool. And like any tool, it needs to be used correctly. Now let's bring everything together. We've covered 6 of the worst gold investments right now. Gold ETFs when misunderstood and used incorrectly. High premium physical gold products that destroy efficiency. Gold mining stocks that behave like risky businesses. Leveraged ETFs that decay over time. Futures and derivatives that amplify risk. And high fee gold IRAs combined with over-allocation mistakes. Different forms, different risks, but all connected by one idea. Misunderstanding, not understanding how the investment actually works. Not understanding the structure. Not understanding the hidden costs. And not understanding the role it should play. And that's the real takeaway, because investing is not about what something is. It's about how it behaves, how it performs, and how it fits into your strategy. Now here's the shift that separates average investors from smart investors. Average investors ask, is gold a good investment? Smart investors ask, what kind of gold exposure makes sense right now? Average investors chase safety. Smart investors balance risk. Average investors react. Smart investors position. And that difference changes everything. Because once you start thinking this way, you don't just avoid bad investments, you start building better ones. More efficient, more strategic, more aligned with how markets actually work. Now here's the final thought. Gold is not the enemy. Bad decisions are. And most bad decisions come from incomplete understanding, not lack of intelligence, not lack of effort, just missing information. And that's what this video is meant to fix. Because once you see these patterns, you can't unsee them. You start noticing premiums, fees, structures, risks everywhere. And that awareness is your advantage. Now I want to leave you with a question. And this is important. When you look at your gold investments right now, are they helping your portfolio or quietly holding it back? Because sometimes the biggest risks are not the obvious ones. They're the ones hiding in plain sight. So what do you think? Which of these gold investments surprised you the most? And do you think gold is still one of the best assets right now, or is it becoming misunderstood? Drop your thoughts in the comments. And if you want to understand markets at a deeper level, not just what to buy, but how to think, make sure you subscribe. Because most people follow markets, smart investors understand them. And that difference is where real wealth is built.